Hi, everyone. Thank you so much for joining us today. We're really excited for today's webinar, which is Sales Tax for Dropshippers, with our founder, Michael Fleming. And before we get started, I will go over some housekeeping items. And I apologize too. I have a dog who's groaning because her life is so hard. So if you hear someone groaning in the background, it's actually my dog just having a hard life. So some housekeeping items before we get started here. So first and foremost, if you are here for CPE credit, we do need you to do a couple things in order to receive that CPE credit. We will need you to answer the poll questions as they pop up on your screen. If you have any issues with that, please send me a message and let me know. I'm more than happy to help you sort that out. We will also need you to fill out the survey at the end of this webinar. So when you exit out, it should auto-populate on your computer. If it doesn't, it will also be emailed to you in 24 hours. And just give us a couple business days in order to get you that CPE credit as well. A couple other important things here. As we're going along, if you have questions, please reach out and ask those questions. If you move your mouse around in the middle of your screen, you'll see a Q&A button. You can use that Q&A button to ask questions at any point during this webinar, and we're going to do our best to address them at the end or following up with you via email. So again, ask those questions anytime you have them. We also will be sending out today's slides and handouts in the chat feature once we get the ball rolling here. They are also already uploaded to Zoom and will be emailed to you again in 24 hours. So there's a few ways to get your hands on those slides and handouts. A couple other important things here. If you love our webinars, but you can't always make them on Thursday, we do offer a pre-recorded version that still offers CPE credit. That is a paid resource that comes with our Salt Vault. The Salt Vault has a lot of other really great resources in it. You can also purchase those webinars one-off as well. And if you have questions about this, please reach out. I would love to answer any of those questions you may have. And a couple other important things here as we're going along. Oh, I guess introductions. So first, for Sales Tax and More, we are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We'd love to hear from you and we would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded and he has helped thousands of companies of all sizes and all industries and is especially well-known for his work in the e-commerce industry. And Mike, if you want to take it from here, let's go ahead and get started.
Absolutely, Ellie. Thank you for that wonderful introduction, and thank you, everyone, for joining us today. I apologize for missing the last week's webinar. We were without power for a week. We had two tornadoes come by, one, about an eighth of a mile to the north of us, one about a quarter of a mile to the south of us, right between. We threaded the needle here, and but it was they were small tornadoes, only F1s, but they still did a heck of a lot of damage, especially to the power lines. But we are bright and sunshine this week. So today we're going to cover what is drop shipping. Whenever we have a webinar like this, I invariably get asked the question, what is drop shipping? We're going to talk about how Wayfair impacted drop shipping. We're going to talk about drop shipping from both a retailer and a supplier side. And then we're going to review drop shipping basics. But before we get to the drop shipping basics, we're going to just review some sales tax basics because it's hard to get drop shipping down if we're not looking at the sales tax basics. And then we're going to go over some resale documentation, but because when we're talking about drop shipping, that resale documentation is usually what trips people up the most. All right, so Ellie, why don't we go to the first poll question?
Absolutely. We just want to get a feel for who's attending today. So the question here is, are you currently drop shipping for your customers, using a drop shipper to fulfill your sales, thinking about drop shipping or just here for the knowledge. And a quick reminder for everyone, you do have to answer these poll questions in order to receive that CPE credit. Mike, it looks like a lot of people are here from for the knowledge, but we have a little bit of a mix as well of other attendees. So I'll leave this open for people to answer, and you can move forward while these responses come in.
All right, let's try to impart some knowledge then. So we'll start with a quick definition of drop shipping, and it's really just a fulfillment method where the seller doesn't have the inventory on hand when they make the sale. Instead, when a seller makes a sale, it's going to purchase that inventory from a third party and have it shipped directly to the customer. Now, this may be for a couple of different reasons. Maybe they just ran out of inventory, and rather than have their vendor ship it to them and then they have to turn around and ship it to the customer, which will increase costs and increase time, they just ask the vendor to ship it directly to their customer. Or nowadays, it's really a fairly cheap way for people to get into business and get started out. You don't have the carrying cost of all of this inventory. So there are some businesses that are set up um, that are drop shippers. That's all they do. They wait until someone gives them an order and then they turn around and they go to their vendor and ask the vendor to ship it directly. So there are a number of different reasons why this may be used, but it does complicate matters when it comes to sales tax. So why are drop shippers impacted so hard by Wayfair? Well, unlike many sellers, some drop shippers possibly had very little nexus or even zero nexus if you were in a state like Oregon. You didn't have to worry about collecting sales tax anywhere. Only now, with the Wayfair, you could potentially have to collect nexus everywhere. Or you could have nexus everywhere, and you could be worried about collecting tax everywhere. And you also have to worry about not paying tax to your suppliers because all of your suppliers, all of a sudden, they are thinking that, well, they're not thinking, they're actually know they need to collect tax in a lot more states because of Wayfair. So all of a sudden, you're getting asked for certificates that you may not have been getting asked for prior to Wayfair. So this is why it's so hard. Um, on people who are doing drop shipping since Wayfair, perhaps impacted harder than any other group out there. All right, so let's look at Wayfair here. Number one, it overturned the uh, Quill Corp versus North Dakota and also the National Bellis Hess cases. These were the two U.S. Supreme Court cases that talked about physical presence. And South Dakota in the Wayfair case, they once again asserted this because the Supreme Court solicited a case. They said, send us the right case and we'll rehear this physical presence issue again. And when the Supreme Court was deciding this issue, they didn't say, hey, times have changed, so we have to change. They did something which at the time was pretty unique. They said we were wrong. We never should have introduced the concept of physical presence to begin with. So what they did is overturn these cases, which is like they never happened, and that ushered in what we have today is an economic nexus, and in an economic nexus, no physical presence is required. This economic nexus can be based on sales. Boy, I'm having a tough time talking today. Can be based on sales, it can be based on transactions, or a combination of the two. South Dakota thought that $100,000 or 200 transactions was fair. The Supreme Court didn't explicitly agree to that. They sort of gave them a wink and a nod, but they sent it back to the lower court, told them to hash it out, but the case was settled before this was hashed out. We're starting to see, including South Dakota, move away from this 200 transactions. Now, when I say starting to move away, um, there's still about 35 to 40% of states that have that. So as soon as I say start to move away, most people say, oh, we don't have to worry about it anymore. You don't have to worry about it in a lot of states, and every year, less and less states do you have to worry about it. But it's still there in some pretty big states like New Jersey and Illinois, very, very aggressive on that 200 transaction side. So states never make anything easy. Each state has their own idea as to what should be included in these transaction thresholds or monetary thresholds. Um, so we have a chart I'm going to show you in a minute. It's one of our handouts that'll help you navigate that. 2 points I want to make when it comes to economic nexus. Number one, um, it doesn't override any other type of nexus. So invariably, I'll have someone say, well, Mike, I want to deregister in the state of Texas. And I'll say, how come? Well, we are underneath the $500,000 uh, sales threshold, and they don't have any transaction threshold. So I want to deregister. And if they're an existing client, I'll say, well, last time we spoke, you know, you had some independent contractors who were traveling into the state, or, in California, maybe you have some inventory in an Amazon warehouse. This is for the state of California. They, again, $500,000 and no transactions. So we have this conversation a lot, Texas and California. And at that point, I have to break to them, unfortunately, that, you know, the physical presence actually is still there. It still matters. As a matter of fact, it's going to override an economic nexus when it comes to sales tax in just about every instance out there. So this doesn't protect you. It's just one more way for the states to get you to do what they want you to do, which is collect and pay their taxes. So big, big point there. I mean, here we are almost 6 years into this, actually 6.5 years into this. And I still get calls like this a couple times a month. Also, this is not an internet issue. Our salespeople still, to this day, again, 6.5 years into this, come to me once or twice a week and say, hey, I talked to this accountant and he told me he doesn't have any clients subject to the internet tax. Well, tax and nexus are two entirely different concepts to begin with. So that's an issue right there. But um, this is not an internet issue. This is a multi-state issue. You don't even have to have a website for this to impact you or your clients. I mean, they can be selling entirely by telephone. They can be selling entirely by referral. They can be selling by infomercial, catalog. It doesn't matter how you're selling. Here's what matters. Are you selling into multiple states, or are they selling into multiple states? And if they are, then uh, this could be an issue for them. Probably is going to be an issue for them if they're of any size. All right, so here's the chart I was talking about. Ellie's going to give this out to you. This chart is invaluable, in my opinion, because all the software companies out there and all the platforms like Shopify, they all say, we'll tell you when you have Nexus. Unfortunately, I don't know of any software out there, or Shopify even, where they can get granular enough in order to give you an accurate reading. So sometimes, like an Avalara, you're not running your marketplace sales like an Amazon through Avalara. So they don't have all of the information to be able to make the determination. So sometimes it's a limitation of the software, sometimes it's a limitation of how we utilize that software. But I've never seen any software be able to accurately predict where you should be registered at this point. Um, Not the way that it's currently being used. So invariably people will come to me and say, well, Mike, I looked in Shopify, it says I should get registered in these 20 states. And it's not looking at, all of the information in this chart. This middle column here, this tells you what you should include or exclude from the transactions. So we look at types of sales to include is retail sales, sales through a marketplace. They'll either be excluded, and a marketplace is Amazon or eBay or something like that. Sales for resale, are they included or excluded? And then exempt sales. So, these people who come to me and say, Mike, uh, the Shopify is telling me to get registered in these 20 plus states. After we look at their exact fact pattern, a lot of times I'll come back and say, no, we only need to be getting registered in these 3 or 4 states because of these issues. So you're invariably going to be getting registered in too many states if you're just looking at the software. Now, the reverse is also true. Every once in a while, you're not putting enough information in there. You're not putting your marketplace sales in there. So sometimes you're not getting registered in enough states. But more often than not, at least in my experience, you or your clients are getting registered in too many states if you're just relying on this type of software. So this is great information. Every time there's a change, we get it updated, and um, we let our clients know in a lot of instances if they only got registered because of the transaction threshold, if that's one that's changed. And we're tracking that in the fourth column, excuse me, the third column here, what the thresholds are. That'll show you what they are and when the transaction threshold went away. We'll tell them that they can get deregistered if that was the only reason that they were registered. Now, every once in a while, state's going to make you wait 12 months, the trailing nexus until that's over. But a lot of the states, especially the more recent states, have allowed you to deregister right away once that law took effect. All right, so uh, this chart here invaluable. It's going to tell you what the look back period is. Is it previous calendar year? Is it previous calendar year or current calendar year? Or is it a rolling 12-month period? And this is up on the free portion of our website. It's always available out there. All right, so let's start talking about some drop shipping. We'll get back to Nexus in a minute, but since we mentioned Wayfair, I wanted to start with Wayfair, bringing in the economic nexus. So why is drop shipping so confusing for so many people? I mean, some people are really smart and they've got this down, but for many of us, it's pretty confusing. And when I first started this, it was hard to get my head around it. And one of the reasons is it's at least 2 transactions. Sometimes I've been involved in some situations where there's 5 or 6 transactions, people buying from people who are shipping, shipping. Um, so they're turning around and buying, but it's at least 2 transactions. So that starts to get a little bit confusing, especially since the terminology is so different on a state by state basis. Some states use the term manufacturer. Well, what happens if you're not a manufacturer? I mean, do the drop shipping rules apply to you or do they not apply to you? So the terminology is going to be different on a state by state basis. Misinformation. A lot of us believe that a sale for resale is a sale for resale no matter what. And unfortunately, that's just not true. So there's a lot of misinformation out there. Disbelief, a lot of disbelief out there along the same lines. And then we either don't know or we've forgotten or we, for whatever reason, we don't apply the basics. So these are some of the reasons why drop shipping is so confusing for so many people. So, like everything in life, if we keep it simple, it's usually a lot easier. So by keeping it simple, we're going to look at each transaction separately. And we're going to standardize our vocabulary, and then we're going to remember to apply the basics. So here's a typical scenario using some standard terms. So a retailer is going to offer products that they don't have in inventory. The consumer then is going to place an order with that retailer, and the retailer is going to turn around and place that order with a supplier. So we're not using the term manufacturer, distributor, vendor. We're just going to use supplier. And they're going to ask that supplier to ship directly to the consumer. So it's still the same definition, but we're going to use some standardized language here. All right, so in keeping it simple, even with it simple, what type of impact does Wayfair have on retailers? Well, as we touched on earlier, you got potential nexus in more states, so there's marketplace complexity on top of that. You used to collect the tax yourself, and so if you were paying tax, then you would just take a credit in a lot of states against the taxes that you were collecting. Not all states you're allowed to do that, but many do. But what happens now that you're not collecting, that the marketplace is collecting? How do you handle that? Well, some states like California put a policy in place. Other states, not so much. We're pretty much on our own to try to figure it out. So there's a lot of marketplace complexity in here. There's more registrations and returns that I have to do. There's more certificate requests from the suppliers. There's more knowledge to learn. And part of that knowledge is what is alternative documentation and can I use that? Alternative documentation, by the way, is only available if you don't have Nexus. So if you have Nexus in a state, you got to do what the state says. Usually you got to be registered and in order to issue a valid certificate. But if you don't have Nexus, if you don't have a responsibility to be registered, then many states, not all, there's 10 tough states out there. We'll go over them later. But most states allow you some type of alternative documentation so that you don't have to get registered in that state. All right, for suppliers, it's really a lot of the same issues here. There's one big difference, though, and that's the last one we'll get into, but you still have potential nexus in more states. More states count resale in their numbers, so that adds another level of complexity there. You got to do more registrations, more sales tax returns to do, more certificates to collect, more knowledge to learn. Now, here's what's different from the retailer. Good faith acceptance issues. Now, what's good faith acceptance mean? In general, if you accept a certificate in good faith and there's a problem with that certificate, the state will generally go after the issuer of the certificate. And there are penalties, both civil and criminal, for the improper use of a certificate. So you want them to be going after the issuer of that certificate rather than you. Now, if you accept it in bad faith or what the state deems to be bad faith, they're going to come after you. So we want to make sure we're accepted in good faith. And we'll get into good faith in a little bit more. But, when it comes to alternative documentation, if we're going to accept that, then if we know that someone has Nexus and you're not allowed to use alternative documentation, if your customer has Nexus in a state, if this retailer has Nexus in a state, what happens if you're the one? What happens if you sent $100,000 of an item into a state for that retailer, or 200 items into that separate items into that state for that one retailer? You yourself have created the nexus. So can you accept a document in good faith that they're giving you saying that they don't have nexus there, don't aren't required to be registered? I don't think that we can. Now, you don't have to put on your detective's hat. You don't have to ask them, hey, what have you done with everyone else? And then add it all up. That's not what I'm saying. If you yourself, as the supplier, as the person who's selling to the retailer, that you got to keep track of what you're selling to any one state for each of these vendors if you're accepting alternative documentation. So it's a little one extra thing that you have to worry about as a supplier. Ellie, why don't we go to the next poll question?
Yeah, that question should be up on everyone's screen right now. What is one reason dropshipping is confusing? And a quick reminder for everyone that you do have to answer these poll questions in order to receive CPE credit. And Mike, right away, people are saying multiple parties are involved. If you want to review this one quickly, I'll leave it open so answers can still kind of trickle in here, but you can go over and then we can move on.
Yeah, this is multiple parties are involved. That's what makes it pretty confusion. The terminology is definitely not the same in every state. Every state words things a little bit different. States don't ever make things easy on us. And not everyone knows the basics. So multiple parties are involved is the correct answer there. All right, so let's talk about some sales tax basics because this is important in order to get drop shipping sales taxability correct. So start out with a definition of nexus. It's just a fancy word means link or connection. And it's the link or connection when we're talking about taxes with a state that has to be present before the state can require you to collect or pay its tax. So we've got to have this link or connection. Could be physical, could be economic, but there's got to be some sort of link or connection there. And that's why we say it all starts with Nexus. And if we don't have Nexus, then we have no problems and no responsibility. That statement refers to sellers. You know, if a seller has Nexus, then they're responsible for getting registered, collecting, and remitting the tax if it is a taxable item. Um, but it's not for buyers. I mean, no nexus. It doesn't matter if a buyer has nexus, and we're going to touch on this a little bit more. Whenever we say no nexus equals no problems and no responsibility, that's for the seller. Now, here at 10 common nexus creating activities, we really go over nexus a lot in lots of our other webinars. So here's just a summary. When we say common nexus creating activities, that's where the majority of the states, if not all of the states, look at something the same way. So this is again is a handout. It's also up on our uh, free portion of our website. It's always available. And these common nexus creating are in direct contrast to these 12 state specific nexus creating activities. And these activities here, the states look at widely different. You know, in some states, maybe there's only one state that thinks one of these items here is nexus creating, but definitely not the majority of the states. And trade shows, every state, you know, looks at trade shows a little bit different. Trade shows, some states say, hey, if you even come here as a consumer, that's going to be a nexus creating activity. I think the states would be hard pressed to enforce that. I've never seen it enforced, but they say it. By and large, you know, the states that say, hey, if you're an exhibitor at a trade show, that's going to be nexus creating. Um, and then there's another group of states out there that say, hey, you can be an exhibitor, but you can't be actively soliciting. Well, pretty fine line there to me, but states do make it. And then you have the next group of states that says, hey, you can even be an exhibitor while you're here. You just can't take any orders while you're here. And then you have the um, state of Nevada, which wants everyone to go to Las Vegas. They say, hey, you can do all of those things. You can you know, come here, you can be an exhibitor, you can actively solicit, you can take orders, but if you're delivering product and taking money at the show, then we want you to collect the sales tax. Now, at the end of the show, you can either give that sales tax to the promoter of the show and have them turn it in for you, Or some promoters won't do that, or you may be too busy. When you get home, just send it on in. Let us know what it's for. And if you're only doing that once a year, then that's not Nexus creating. If you're doing that more than once a year, then it is Nexus creating. So uh, lots and lots of different ways that states look at trade shows. And by the way, people always like to throw the term de minimis out there, de minimis activity. Only problem is states don't really define what a de minimis activity is, except when it comes to trade shows. There are some states that actually define what a de minimis activity is. And they have language like if you're here for less than 7 days a year or less than 2 weeks a year. There's one state that says if you're here for less than 2 weeks a year and generate less than $100,000. So there's lots of de minimis language when it comes to trade shows. So again, this will be up on our website. And unfortunately, you got to, look at the states on a state by state basis when looking at these types of activities. All right, so let's look at rates real quick. One of the biggest questions we ever get is which state's rate do we use? Now, for interstate sales of tangible personal property, in other words, if something's crossing a state line, the delivery address, sometimes called a consumer state address, is almost always going to be the rate that we're going to use. So wherever it's being shipped to, regardless of who's paying for the shipping, who's ordering the shipping, if it's being shipped somewhere, that's generally where that sale is going to be sourced. Now, for intrastate sale, if it never crosses a state line, that's when the term origin or destination based sourcing comes in, because then it can be either, depending on the state. Now, there are some software companies out there that make such a big deal out of this origin based uh, rules that we'll be talking to people on the phone and they'll say, well, Mike, I'm in an origin based state. I don't have to worry about sales tax anywhere. And no, it does not mean that at all. Origin shipping just means what local shipping rate should you use? Do you use it where you're shipping from or do you use it where you're shipping to? But whenever it's crossing a state line, origin's out the window. It's almost universally going to be where is it being shipped to? So very, very important. And this is something we've got to keep in mind when we get to the drop shipping. All right, so when should a tax be collected? Sellers generally required to collect the delivery state tax, consumer state tax, interchangeable, or a certificate in lieu of the tax that is acceptable to the delivery state if what they sell is taxable and they have nexus in the delivery state. So it's never based on where the purchaser has nexus. Now, do you ever ask your customers or do your clients ever ask their customers, hey, where do you have nexus where I'm shipping this? Because if you have nexus, I need to charge you tax. And if you don't have nexus, I'm not going to charge you the tax. Doesn't work that way. It's the seller. The seller has a responsibility. They don't have an option. They must either collect the tax in the delivery state or collect a certificate in lieu of that tax. Now, if the sale's being sourced to that delivery state, should we not have to provide some sort of acceptable certificate to that delivery state? Shouldn't they say, yeah, this is okay? Because if it's not okay, they're the ones that are going to be charging us the tax. And that's where some of the problems are going to come in, and we're going to talk about them a little bit later. You may collect a properly completed certificate acceptable in the delivery state. This is basically what we've just said here. Now, this second part here is important. If a sale for resale is not properly documented, then the state may not recognize it as a sale for resale. And uh, that hasn't always been the case. If we go back to 2008, 2009, 2010, States gave you a lot of latitude. Auditors gave you a lot of latitude. If they knew a sale was for resale or some other type of exempt sale, um, they let you slide. And some companies that, like distributors, all they did were sales for resale. They weren't even, targets for audits really. But that began to change. Back in the Great Recession, 2008, 2009, 2010, states needed money so badly, and their constituents, the people living in those states, they didn't want to raise the taxes on them. So they said, what can we do? How can we start, enforcing rules that are on the books so that we could raise more revenue? And they said, you know what? We never enforced the rules on certificates. So virtually overnight, it went from a matter of substance over form. In other words, what's really going on here versus how it's documented, to the exact opposite. Now it's more important how it's documented over what's actually going on. So at this point, every I has to be dotted, every T has to be crossed, or that certificate is getting kicked in an audit. And when the states first started doing this, they were extremely successful because people just weren't paying attention to their certificates and they raised a whole bunch of money. Now, when things got better, you would think that they backed away from this policy a little bit, but unfortunately, that's not the way it works. Once they got a taste of that money, if anything, it has accelerated since then. And at this point, missing, incomplete, or invalid certificates, they're a leading cause for large assessments in companies that are required to collect certificates. It's the number one cause. So we got to pay attention to to the certificates because the states view this as low-hanging fruit. Now, when is an exempt sale not exempt? When it's not properly documented. So if you don't have every I dotted and every T crossed, the state may not recognize it as an exempt sale. So it's important. We're going to talk about validation and towards the end of the webinar here, but we'll go over more what that means. But even one missing or invalid certificate can create huge problems in an audit because audits nowadays are often done using samples. So we do a lot of exemption certificate management, and we suggest to our clients we would reject this certificate and give them the reason why. And a lot of times the salespeople get involved and they say, "Hey, this is our biggest customer. We need to make an exception." And all of a sudden, I get notified from our people here, that are reviewing the certificates that, hey, they're overriding everything we do. And I usually have to talk to someone in charge at the company then and say, hey, it's not just the tax on this one certificate, on this one invoice that we're worried about. Because audits are done on a sample basis, it's the error percentage when you extrapolate it out over the population. I'll give you an example. There was one audit I was involved in, and it was about a $3.5 million audit. About 60% of it was related to certificates. And it came to us, it was a Texas audit, came to us after the audit phase was over, it was going to redetermination. And we were able to go out, and you only have a certain amount of time in most states to get the certificates perfected. Texas gives you a very limited amount of time to do that. And uh, we were very successful. In defending this audit, we got it down to about $15,000. We got every single missing certificate perfected. They were either missing or something wrong with them, except for one. And this one certificate was for a piece of heavy earth moving equipment. And the tax on this one certificate would have been about $8,000. So if we were able to have gotten that, it would have been a $17,000. And if we were able to have gotten it excluded from the sample and just itemized, it would have been a $25,000 audit. But we did so well on this audit, they would not let us exclude this from the sample. They said, no, it's staying in there. And when it was extrapolated out, the error percentage over the population, it was over a $270,000 error. Now, That took us to just under $300,000. The client was ecstatic because we took it down from 3.5 million to just under 300,000. But if they had just been able to get this one certificate, um, would have been a $17,000 audit. Now, most of you are saying, well, my clients don't have invoices with $8,000 of tax. Well, the concept is still the same. Maybe you have 20 invoices or 30 invoices or 100 invoices, and they total um, $8,000 in tax, and they're all invalid. Same thing. Missing certificates, because audits are done on a sample basis, usually have an outsized impact on the audit. And when I explain that to the owners of these companies or the managers, the people in charge, they say, "Oh my, I didn't realize that." And all of a sudden, you start to see a change. All of a sudden, there's pushback against the salespeople and the customers because it's just too much risk out there. Ellie, let's go to the next poll question.
Absolutely. That question should be up on everyone's screen right now. Quick reminder that you do need to answer these poll questions in order to receive CPE credit. The question we have here is, which is one of the most difficult states? Your choices are California, New York, Pennsylvania, and Texas. Mike, why don't we kind of do the same thing we've been doing here? We'll leave this open, you can review, and I'll close it out in a little bit here.
Yeah, absolutely. And I think we got ahead of ourselves on the slides here with this poll question because we're going to go over this. We just haven't gotten to it yet. Many of you are
So take
intuitively
your
get,
best guess. Yeah.
yeah, take your best guess. We'll bring you the results. Most of you are intuitively getting this right. California. It is the one of the 10 tough states out there that we're going to talk about. New York, Pennsylvania, and Texas are relatively easy. The three of those will accept different types of alternative documentation, while California not so much. So we will go over this. Right now, let's talk about the problems created by drop shipping. For suppliers, it's exposure. If you're not tough enough on collecting the right certificates, you got, a lot of liability, potential liability out there. So the exposure, um, if you're being too tough on collecting, either because of a lack of knowledge, knowing about acceptable alternative documentation, or just the rules, the basics, um, this is not only, a tax issue, but it can become a customer service issue, a sales issue. If you don't know how to communicate with your customers, um, someone, if they don't understand why you're asking for this for something, they may just go to one of your competitors. They're not charging me tax, and the competitor may be doing it wrong. But because there's not enough communication, and that retailer, that customer of the supplier is just digging their heels in, it becomes not only a tax issue, but a customer service and sales issue. And problems created by drop shipping for retailers. Number one, there may be overpayment of tax. Their suppliers are asking them for the tax because they think they need to. Needless registrations. A lot of suppliers will say, go out and get registered everywhere. And then there's the ruined relationships. You're digging your heel in because you're saying a sale for resale is a sale for resale. And why are you charging me tax? And I'm just going to go elsewhere. So a lot of these are problems that can be created because of drop shipping. They can be solved with a little education. And we need to be talking to our customers, our suppliers. It goes up chain. Lots of times retailers have bought me in and asked me to speak to their suppliers on why they can accept alternative documentation in certain circumstances. So it goes both ways. But let's work it out. Let's go through a scenario. And a lot of people look at a drop shipping relationship as one transaction. We mentioned this earlier. It goes from the consumer to the retailer to the supplier, and then it goes back to the consumer. The supplier shipping it to the consumer. And if I'm looking at that as one transaction, I'm scratching my head, which is why I want to keep it simple. It's really two transactions. The first transaction is between the consumer and the retailer. And then the second transaction is between the retailer and the supplier, with the supplier shipping directly to the consumer. So the first transaction, relatively simple. If the retailer has Nexus and or is registered in the delivery state, then the retailer is obligated to collect the tax if what they sell is taxable and the consumer is not exempt. Pretty standard there. So if we understand the basics of sales tax, we understand what our responsibilities are there. It's this second transaction that can give us a little bit of heartache. And there's really three scenarios here. So the first scenario, the supplier does not have Nexus. Okay, so the supplier is the seller. Remember earlier we said no Nexus equals no problems and no responsibilities. So if the supplier does not have Nexus and is not registered in the delivery state, then the supplier does not have to ask the retailer for anything, and no tax is charged from the supplier to the retailer. So this is a pretty simple one too. Again, it falls back to the basics. If I don't have Nexus, I don't have to worry about collecting tax. Paying tax, another story. But let's go to the second scenario. The supplier has Nexus and the retailer is registered. Okay, this is a fairly easy one too. The supplier is going to say, I need a certificate that is acceptable to the delivery state. And if the retailer is registered there, they just turn around and give them the certificate. Fairly simple. Here's the one that gives everyone the most angst. What happens if the supplier does have Nexus and the retailer is not registered? So if the supplier has Nexus and or is registered in the delivery state, then the supplier must ask the retailer for a certificate. And if the retailer is not registered in the consumer state, then the supplier may have to charge the retailer a sales or vendor's use tax, seller's use tax, something along those lines, not a consumer use tax. Sometimes the tax is a seller's use tax or a vendor's use tax. So the second transaction, let's put this in real world examples. This is scenario 3. We said California, one of the tough states out there. So the supplier has Nexus in California. The retailer does not have Nexus in California. The supplier is located in Oklahoma. The retailer is located in Texas, and the consumer is in California. So how does the tax work in this scenario? Well, let's remember the basics. Delivery state determines which state or certificate to collect. Nexus of the supplier is key. A seller never asks their customers, and in this case, the retailer is the customer of the supplier. So a supplier or a seller never asks their customer if they have Nexus in a state when deciding if they need to collect tax. It's all based on where they have Nexus. And a supplier must collect the tax or a certificate in lieu of the tax acceptable to the delivery state. They have no options. They got to do one or the other. And a sale for resale may not be exempt if it's not properly documented. So these are the basics we have to remember. So that we've established that the supplier has Nexus in California. They're shipping to California because that's where the consumer is. So they must collect the California tax or the certificate. So this is the Oklahoma supplier. The retailer does not have Nexus in California. They're not registered in California, so they don't have a valid certificate to provide the Oklahoma supplier. So that's why the supplier must charge them the California tax. So California is a little bit different. They say the supplier must collect the tax not on the price that the retailer is paying them, but on the sales price to the consumer, if known, which it's usually not, or their price to the retailer, that would be the wholesale price, plus 10%. And a lot of suppliers get this wrong. They never do this 10% markup. They get audited, and that 10% adds up over hundreds or thousands of transactions. So knowing the rules in each state is very, very important. The retailer, they have to pay the tax. They have no option. They can't say, I don't have Nexus in California, therefore, you you don't charge me the tax. No. Uh, the supplier has Nexus. They have to collect the tax or a valid certificate. And unfortunately, California, you can only issue a valid certificate there if you are actually registered in California. Now, there's some exceptions to that. We'll, you know, touch on them a little bit later. But in general, uh, the the certificate, you've got to be registered to issue a valid certificate in the state of California. So the retailer has no option, and they can get into it with their supplier and till they're blue in the face. If the supplier knows what they're doing, they're collecting the tax correctly. Um, so we've got to remember sale for resale. If we give in to the retailer, it's not going to be recognized. And the nexus of the purchaser, we've got to make the purchaser, which is the retailer in this case, understand that. Now, this leads to if you've got a lot of sales in California, you still don't have a responsibility to collect. Sometimes it's cheaper to register voluntarily in a state than to pay all of the tax based on your sales price plus 10% to your supplier. Yes, there's a cost of compliance, but it's usually a whole lot less than what you're going to be paying your suppliers in tax. Unless you don't do a whole lot of business there. Maybe you do a drop shipment there once in a blue moon, and then just pay the tax to your supplier if that's a lot cheaper than trying to become compliant if this is not a regular thing. So, Ellie, why don't we go to the next poll question?
Absolutely. We have a quick true or false question here. The delivery state determine which state's rate or certificate to collect, true or false. And again, I'll just keep putting these reminders out there. You do have to answer these poll questions in order to receive CPE credit. Mike, most people are responding true. I'll leave this open a little bit longer and you can review and let's move forward.
Yes, it's the delivery state, or sometimes called the consumer state, that is going to determine where the sale is sourced and therefore which state's certificate to use. All right, so we talked about alternative resale documentation. What is it? And again, states don't make anything easy. So what each one will accept is, if they'll accept anything, is going to be a little bit different. So some of the things that are considered alternative resale documentation, home state certificate. Sometimes you can use your home state certificate. Sometimes you can use the consumer state or delivery state certificate with a no nexus statement. Sometimes you can use a consumer state or delivery state certificate with home state numbers. There's the streamlined sales tax multi-jurisdictional certificate. There's the MTC multi-jurisdictional certificate. There's affidavits of no nexus, customer pass-throughs, and sales tax permits. Usually not allowed. Very few exceptions, very few states allow sales tax permits. Now, in order to make this easy, we have a proprietary chart here, and we're going to go through examples using this chart. If you're doing a lot of drop shipping or your clients are doing a lot of drop shipping, this chart is invaluable. Now, this chart is only available through our Salt Vault. That's the paid portion of our website. I think that subscription, if you're doing a lot of drop shipping for this reason alone, it's worth that money. But there's a ton of resources in there. Now, look at the third column. It says delivery state certificates with no nexus statements, and the fourth column, delivery state certificates with home state numbers. We're going to do two examples of those. Now, if we go to the final column, pass-through of a customer's valid exemption. This is allowed in some states, and it is allowed in California. However, I see more fraud when it comes to this than anything else. I mean, unfortunately, not everybody in the world is honest. And sometimes, in order to avoid paying the taxes, they'll say, hey, I know you're not selling this for resale. I know you're going to use it in your business, but if you give me a resale certificate, then I don't have to charge you tax. And then they turn around and they take that certificate and they pass it through to the company. Well, it's not a sale for resale. You're not reselling it. You're using it in your business. That's not eligible for that type of transaction. So while it is allowed in some states, and California being one of those states, it's rife with all sorts of shenanigans going on. All right, so let's get into some examples of certificates. This first one we're going to look at is Pennsylvania. And Pennsylvania is an example of a no nexus statement. So when we're filling out certificates, number one, we want to go to the top here. We're going to check the top one. It says state and local sales and use tax. It's right underneath where it says Pennsylvania exemption certificate. Then we're going to come down here and we're going to check one of these boxes. And you want to generally check the one that's a blanket exemption certificate. If you don't, every time you do a transaction with this vendor, you got to give them a new certificate. That's going to get old pretty quick for you and for your supplier slash vendor. So if you check blanket, all of the same type of transactions you do with that supplier are going to be uh, covered by this one certificate. So you put the seller's name on there, and then you fill out the rest of it. You're going to go down to box number 3. It says property will be resold under a license ID. You can put not applicable in there because in the brackets out here, it says if purchaser does not have a Pennsylvania sales tax license ID, include a statement under number 8 explaining why a number is not required. So you go to box number 8, you check that, and you say, we do not have nexus in the state of Pennsylvania. So that's why this is an example of a delivery state or consumer state certificate with a no nexus statement. By the way, you can just go online and do a search, Pennsylvania exemption certificate, and it's going to pull up this certificate. You can just download it and fill it out and give it to your vendor or the vendor. You're not allowed to tell them what exemption they are uh, eligible for, but once they tell you, hey, I've got a resale exemption, then you can provide them the correct certificate. All right, so here's a delivery state certificate. This is an example of delivery state certificate or consumer state certificate with a home state number. So um, you're going to fill out the top left here, name of seller, name of purchaser, the top right. Then you're going to mark a box, single use or blanket. Again, we want to be checking blanket. Um, then it's the purchaser information. And remember we said that good faith acceptance? Well, part of good faith acceptance is common sense. So I'm engaged in the business of uh, software development and principally sell software. Now, if they're buying a desk from you and they put software development and principally sell um, software, does it make sense that they're buying one desk from you for resale? Probably not. At best, you got to ask additional questions, and the question should be, "Hey, what's going on here? Why are you buying one desk?" Oh, because we've decided to expand. We think that software is close enough to office desks that we're going to leverage the market and we're going to be selling many desks on a going forward basis. Okay, that sort of makes sense. Invariably, though, they can't give you an answer that's acceptable. common sense tells you that they're going to use this in their own business. They're buying one desk. They don't sell desks. So how can they be buying it for resale? There is no God-given right to a resale exemption. Since the seller, the supplier, is going to be on the hook for this, they can decline whatever they want to decline. They can choose not to accept it. And in many instances, they should. When we're examining certificates for our clients, we're doing the validation, we often say this should be rejected. All right, so let's say it all makes sense. We go down to part number one. You're going to skip that because this says it's to be completed by registered New York State vendors. You're going to go down to part two. And you're certifying that you're not registered, nor are you required to be registered in New York. That's the important part, required to be registered. Then you're telling them you are registered to collect tax in the following state or jurisdiction. And if you're from Canada, you can write Canada in there. If you're from a state, you write the state in there. Whatever country you're in, you can write in there. And the next line, you're going to put your number. So you can put a GST number in there. You can put your home state number in there. If you're from a state like Oregon that doesn't have a sales tax or a general sales tax, then you put not applicable in there. And this is an example. And again, this is a delivery state or consumer state with a home state number. And again, it can be downloaded from the internet and real easy to do. All right, so the streamlined sales tax certificate, it's one of the multi-jurisdictional certificates out there. And I think that if you're doing a lot of drop shipping, this is the one that you should be using. Now, there are not as many states on this one as there are in the state tax commission multi-jurisdictional certificate, but that's going to get you in a lot of trouble where this one should keep you pretty clean. So again, box number one, check if this certificate is for a single purchase. Enter the related invoice. You don't want to check that unless there's some specific reason you do. In general, you want to leave it blank so that you can use this as a blanket certificate. Number two, you're going to put your purchaser's name. You're going to put the purchaser's business address. Then you're going to put the seller's information, the seller's address. And then you're going to put the purchaser's type of business. Again, this comes down to that common sense. Does it make common sense? Now, on the bottom of the page, it says enter your ID number. Well, these are all the states that will accept a home state number if you do not have nexus in one of these states. So let's say you only have nexus in the state of Wyoming. Well, you can put your home state number in for Arkansas, that AR, draw a line down both columns to Wyoming, and then put your number there. The ID number you can put in Arkansas and draw a line down. But if you do have Nexus, then you should be registered and you need to be writing in your actual state number in each one of these places. So all of these states will accept the home state number if you don't have Nexus in that delivery state. So this is a pretty easy certificate to work with. Now, here are those 10 most difficult states that we're talking about. In some or all circumstances, you're going to have to be registered in order to issue a valid certificate. Now, Tennessee, we removed that back in 2022. Illinois, we used to consider honorable mention. Illinois is now one of the 10 top ones. It replaces Tennessee. Illinois is a little bit different than the other states. Illinois said that you're allowed to utilize whatever you want. However, if you use any certificate other than an Illinois specific certificate, it's subject to additional verification. And what that means is the auditor gets to put on their detective's hat. I mean, if it's on the Illinois form and you accept it in good faith, no detective's hat. The auditor cannot put on their detective's hat. If it's not accepted in good faith, that's when they get to put on that detective's hat. So as a best practice, we generally tell our clients to only accept Illinois approved certificates. And one of the certificates in Illinois, it's a resale certificate. You can get registered for it and not have an obligation to collect sales tax. You only use it to put on the resale certificate. So it protects your supplier and it protects you. So you got to be careful when you're registering, though, because it's real easy to get registered for the retailer's occupation tax rather than the reseller's tax. But if you're careful, if you make a mistake, just call the state and say, "Hey, I made a mistake. I need a resale registration, not the retail occupation registration." Some states like Florida, they're going to look at where the inventory was at the point of sale. If it was outside of the state of Florida, Florida doesn't consider that sale source there, and therefore you can provide any type of resale certificate. If it was located in the state of Florida, then they consider that a Florida source sale, and you have to be registered in the state of Florida in order to issue that valid certificate. Louisiana, very, very similar. Now, the problem is a lot of suppliers don't know where they're going to ship from at the point of sale. Maybe they have a warehouse in Georgia and one in Florida. So, as a corporate decision, they decide we're only going to accept Florida certificates. People who are registered in Florida can issue a valid certificate because we don't know until after the fact where we're going to be shipping from. So again, tough states. In some or all circumstances, the you got to be registered in the state to issue the certificates. All right, Ellie, let's go to the next poll question.
Yeah, trickiest question of the day here. Are you going to join us for our next webinar? We hope to see you there, and we hope you enjoyed today's webinar. I just want to remind everyone again, if you have questions as we're in the last bit of our webinar here, you can use the Q&A button to ask those questions. If you want to work with us or have questions about our services, please reach out. We'd love to hear from you. And Mike, I'll leave this open, and I'll let you keep going forward.
Well, we've either got a very nice group today, or I'm not doing as bad as I thought. No one said they're not showing up. They're either saying yes or they're going to do their best to come. So either very polite group or we might be effective today, despite my problems being able to speak. So thank you, everyone. So collecting tax from retailers, the tax is generally going to be based on one of these things: the price to the consumer, if known, and if that's not known, then the wholesale price. And in California, it's the wholesale price plus the 10%. We'll get into this example in a minute. But some states just say it's based on the wholesale price. We're going to keep it simple. Why get the price to the consumer if known? No one ever knows that anyway. So the fallback is wholesale price. Now in California, let's go walk through this example. We got to do wholesale plus 10%. So on a $100 sales price, you don't collect if the tax rate is 8%, you don't collect $8. Got to collect $8.80. And that's what I talked about on hundreds of transactions or thousands of transactions. That 80 cents adds up quickly. The way you get to that is it's the $100 sales price plus 10%. That would give us $110 for the tax basis. That's not the price that the retailer pays. The retailer pays the same sales price. They're going to just pay that $100, only they're going to pay the higher tax amount because that 8% is based on 110 for the tax basis, not for the sales price, but for the tax basis. So they'll be paying that $8.80. And that's what I'm talking about. Why pay your vendor $8.80 if you could be collecting 8% from your customer, and the customer's actually paying it rather than you? So It's yeah, you're registered now and you got to collect and remit the taxes, or your client has to collect and remit the taxes, but it's usually a lot cheaper than paying the supplier. All right. I said we were going to talk about certificate validation, and it's not just enough to collect a certificate. Someone must be reviewing that certificate for the most common reasons it could be kicked during an audit. I mean, who cares if you have something on file if it's not going to protect you? And I joke about this, but barely. It's a joke. I have, seen where, in a lot of firms or companies out there, the salespeople are the ones responsible for collecting certificates. And I've seen death certificates, birth certificates, marriage certificates. If it says certificate, I've seen it. A lot of times, sales tax permits, and most states are going to reject a sales tax permit. I mean, you got to have uh, uh, the right certificate. It's got to be completely filled out. It's got to be signed and dated. We're going to go through some examples here, but someone's got to be doing this certificate validation. This is what we do a lot of. We validate people's certificates. And it's not as easy as you think. People always say, I got my certificates down. And we say, okay, send us 25 certificates. We'll do a spot check. Or actually send us 25 send us last month's exempt transactions. We'll pick 25 certificates. I got it right that time. And then we'll ask them to provide us the certificates for those randomly chosen 25 certificates, and we'll go through them. And people who thought they were, 100% spot on, 80% failure rates. And when I say failure rate, the likelihood of that certificate being kicked in an audit is very, very high. So someone's got to be doing this certificate validation. For our exemption certificate management program, this is standard. We do not accept certificates without validating them. That's built into our program. Other companies, not so much. You may be having them manage your certificates, but unless you're paying for something extra, they are not doing the validation. And to me, that's only part of the job. Someone's got to be doing the validation. Otherwise, you're fooling yourself and thinking that um, you're protected. Now, what reasons would a certificate be kicked? Well, very common reasons. Everywhere there's a circle, very common reason. It's just not completely filled out. You have to have the name of the purchaser up there. This is a Texas state certificate. If you have a registration number, you have to put it up there. By the way, you don't have to check the numbers to make sure that they're accurate, but you got to check them to make sure there's 11 digits. If there's 10 digits, this is going to be kicked during an audit. If there are 12 digits, it's going to be kicked during an audit. So you got to check to make sure there are only 11 digits there, or there are at least there are 11 digits there. Any other number, it's going to be kicked during an audit. And they make it easy for you. You put your home state number there, or an out of state registration number. So then you're going to put the seller's information. You're going to put the description of the items to be purchased. Now, here comes that common sense again. You go up to the right-hand corner, description of the type of business activity generally engaged in, or types of items normally sold. So let's use that same example. I'm a computer software developer and I sell software and I'm buying a desk. Should be kicked. At the very least, got to ask some tough questions. And then it's got to be signed and dated. This is by far the biggest one. They're not signed and they're not dated. So, very, very important that someone is validating it. It's not rocket science. It's got to be on the right form. That's probably the toughest part. All of it has to be completely filled out. It's got to pass the common sense test. And there actually has to be an exemption available. Someone could be claiming the ABC exemption, and the state doesn't have an ABC exemption. You need to know if there's an ABC exemption or not. So resale, that's a pretty easy one, but if they're claiming some other type of exemption. So we said we're going to talk more about the MTC certificate. Here's the MTC. Look at how many footnotes are on there. Every state except for Nevada, New Jersey, Iowa, Arkansas, they pretty much have Tennessee. Most of the states on here have a footnote. So here's what the footnotes are. There's pages and pages and pages of footnotes. Not one of these footnotes, to the best of my knowledge, I've been through it a couple of times. I don't know what the most recent version says, but none of them tell you if you can use a home state number or not. So we see a lot of companies getting themselves in trouble. This is a great certificate. It has a whole bunch of states listed on here. So if you're selling to brick and mortar locations, then they're probably going to have all these numbers. And this is a real easy to certificate to accept from them. But if you're doing a lot of drop shipping, I would not accept this unless you know inside and out whether a home state number could be used. And our chart will help you out on that. It'll tell you when you can use it. But these footnotes do not. So this is where I see people getting themselves in a lot of trouble. They don't know what can be input on this sheet. They allow the home state numbers, and all of a sudden they get audited by the state in question. And next thing you know, they've got a huge uh, audit assessment due to certificates. So very, very important. If you're doing a lot of drop shipping and don't understand what can and cannot be used on this, like the back of your hand, stick to that streamlined sales tax certificate. The home state certificate can be used in every state there, so long as the issuer doesn't have nexus and so long as you didn't put them over the threshold, then you don't have to put on your detective's hat. And if they issued it incorrectly, if they gave you a home state number when they should not have, in general, the state's going to go after them, so provided you accepted it in good faith. So, marketplace sellers and drop shipping, we touched on this earlier today. Many states have not addressed the issue. Believe it or not, California actually does a pretty good job explaining a workaround. So, in California, a certificate can be supplied or accepted without a California permit number. It's really the only time it can happen. The certificate must state that the sale is being facilitated by a marketplace who is collecting the tax and why the purchaser is not required to be registered. The marketplace's tax ID should be included if possible. That's pretty tough to get. You're not going to be able to get that all the time. So if you leave it off, it's fine, but you have to have the rest of the information. Now, one of the problems I see a number of people making is taking this information from California and applying it across the board. And states are very finicky as to what they will and will not accept. If a state has not explicitly said they'll accept this, I think that you need to collect the tax if they're not registered. So, um, especially if the numbers involved are material. It's a one-off. Okay, that's not too bad. But if you're doing a lot of drop shipping, you got to know what each state will or will not accept. And to the best of my knowledge, California is the only one. And, there may be some newer states, but the last time I did research into this, California was the only state that's addressed this specifically. And at this point, Ellie, we want to open it up to questions?
Yeah, we don't currently have any questions, Mike. So if there's anything else you want to go over, this is a good time. If not, and if anyone has to head out, thank you so much for joining us. We love having you here, and please join us for future webinars. So anything else you want to add in here, Mike?
Well, you should never give me an opening.
Really?
Um, I just like to make this public service announcement. Software companies are what I consider a necessary evil out there. You got to have them for the automation. It's too hard with over 13,000 taxing jurisdictions out there if you're doing a lot of transactions to try to figure rates on your own. So we've got to use some software company. And the software companies, some are better than others when it comes to figuring out the taxability and the rates. Where software companies get themselves in trouble is when they start to perform services. And Right now, times are tough for many companies out there, and they're looking to cut costs wherever they can. And you get someone like an Avalara that comes along and says, "We'll do your returns for free in these 20 some odd states." That's pretty alluring, but there's always a catch. Free is never free. Um, I got to tell you, if you've listened to me before, you know about the horror stories I talk about. That list of horror stories continuously grows. Um, and there's just not anyone to talk about there. I mean, last I heard, they've outsourced all of their help to one of the foreign countries. So you got someone in another country that is even used to sales tax and there's a little bit of a language barrier trying to explain to you what's going on. I mean, hundreds of thousands of dollars people come to us with problems because they're entrusting software companies to do services. And it's my public service announcement. Obviously, I'd like to see you and or your clients come with us. We, use a white glove approach. Everyone is assigned a staff accountant. If you have questions, you talk to the person actually doing your returns. Um, Not so much when you're dealing with these software companies. So know what you're getting yourself into or know what you're getting your clients into. Um, you can listen to any of our other webinars where we explain these different situations. You can call us directly and say what to look out for. Here's one. If you're selling it to Washington and you have to worry about paying the business and occupation tax, well, whoever's doing your taxes now is doing that for you because it's part of the sales tax return. But you go with the Avalara and the salesperson tells you just set it and forget it. You don't have to worry about anything. Well, in that very, very fine print in the agreement, they tell you we don't do all returns. So all of a sudden, it's 3 years down the road, the state of Washington is calling you and say, "Hey, we know that you're paying sales tax through the streamlined program, but what about the business and occupation tax? You're not paying that anymore." Um, and it's because the business and occupation tax is not part of the streamlined form. So it just gets lost. And we're seeing more and more of issues like that. Um, and we're also seeing a lot of the home rule states where the local jurisdictions are not being handled correctly. And tax collected, not remitted issues. So just be careful. When you're advising your clients, make sure that you got all of the facts. And cheap is not always cheap. Cheap is usually the enemy of good. Software, we got to have it. Software companies doing services, it's not their specialty. They happen to be doing sales tax. That's what their software does. Doesn't mean they understand what they're doing. And they may be doing lots of returns. Doesn't mean they're doing them correctly. So that's my public service announcement. It's my bash for the day. Ellie knows she shouldn't give me an inch because I'll get on my soapbox and talk about it. But we've had a couple of big issues come up this week. So again, I just want to talk about it. And now, thank you for listening to me. Thank you for letting me rant. And at this point, I want to thank you all for coming today. And if anyone has any follow-up questions, just let us know and we'll see how we can get them answered for you. Thank you, everyone. Bye-bye.